Market goes down, it's a very natural phenomena for investors to get nervous and to even be a little fearful. I heard a great definition actually of courage one time. And the definition goes like this. Courage is not the absence of fear, but it's doing the right thing, feeling fear, but still doing the right thing. And that's really, when it comes to investing, it's really an important part of our... This is not working, Elliot. Okay, there we go. This is Jason Zewig. He said this. He said, a bear market is a gift from the financial gods, and the longer it lasts, the better off we will be. Instead of running from the bear, you should embrace it. Now, that sounds great, right, on paper. Not so easy to do, though, because when the markets go down, and this is a bear here, okay, little girl hugging the bear, it's kind of hard to hug the bear, right, because the bear that investors face has a lot of thorns on it. Sometimes it can be painful to see our accounts go down in value. So what I want to do, this little presentation kind of gives another perspective to what's going on in the markets, how to maybe adjust our thinking or adjust our emotions towards what's happening as well. And it'll give you a little bit of what I call a 30,000-foot perspective. So, okay, get the big view of what's going on. If a stock that I own goes down 50%, I would look forward to it. In fact, I would offer you a significant sum of money if you could give me the opportunity for all of my stocks to go down 50% over the next month. That's pretty gutsy, right? That's Warren Buffett. One time Warren Buffett was asked, well, what's your average holding period for stocks? You know what his answer was? Forever. Meaning he doesn't get out. So the moral of the story is that you buy stocks when they're on sale. Okay, if you already have stocks, then buy more. That's another thing which is kind of hard for investors to get their heads around. Okay, if the market goes, so if there's a sale, for example, at Macy's, and Macy's puts a big flyer in the Sunday newspaper. It says 50% off on all clothing and merchandise. What do you think is going to happen on that weekend? People will just be flooding the store. You won't even be able to find a spot in the parking lot. But when stocks go on sale, what happens to investors? It's a different story, okay? Because there's something called recency bias with investors. And it's kind of like our mind plays a trick on us. Because if we see something going up, what do investors generally think? Like investors who own Apple stock. They kept seeing it go up and up. And I know Dave and I met with a couple of clients who owned Apple stock. And they just think that it's going to do what? Keep going up. That's called recency bias. Well, fortunately, the clients we met with, they decided to liquidate some of their Apple stock when it was at the peak. Sure enough, what was it, Dave? A couple months later? Went down 30% a couple months later. The opposite is true also, though. When we see the market going down, there's kind of a recency bias, and investors tend to think, well, it's going to continue to go down. But that's not the case. If you go back to 1926, the market has gone up if you take all the years since 1926, which is about 84 years, the market's gone up, I think it's 64 times the market's been up, and 24 years the market's been down. So what that just simply says is that for every 1 year the market goes down, it's up 2 years. Now if you could go to Las Vegas and find a machine and sit in front of the machine and you lost once but you win twice, how long could you sit at that machine? Quite a long time. But it's this concept that it's hard to grasp. So here's the other issue. The other issue is that, and this is what we try to do when we built your portfolio. So your portfolios are engineered in such a way that you have a broad diversification. Anybody know how many individual stocks you own in your portfolios? I know I've mentioned it before, but any idea? About 12,000. In how many countries? 46. So 46 countries. So you have a globally diversified portfolio with over 12,000 individual stocks. So there's always this fear that investors have when they see the market go down that it'll just continue to go down. But market downturns are temporary. They're not permanent. And the average length of time it's taken, historically going back to 1926, the average length of time it's taken for a market to recover from its bottom is 111 days. 111 days. Now, a bull market though, a bear market, okay, right now you could say, well, we're in a kind of a bear market. We're in a mini bear market. Because a real bear market would be down about 20%. Right now the market's down what? How much, Dave, Craig?
This year, 9%.
About 9%. 9 or 10% the market's down. Now, a lot of the portfolios you have are not down that much. Okay, because we've engineered it in a way that it reduces the volatility. Okay, but a real bear market will go down about 20%. The S&P 500 in 2008, when we had a severe bear market in 2008, the S&P 500 was down 37%. That's tough. That is a hard one to take. And that's why we don't recommend you just investing in the S&P 500. That's the very reason. So not all asset categories act the same. So here's an example. So these are some of the asset categories, okay, that you can invest in. There's actually a total of about 19 different asset categories. So we're talking about large value, small value, international large value, international small value, emerging markets, microcap companies, and then short-term fixed income, U.S. government bonds. So when you add all those up, it's about 19. So this is just like 7. So the S&P 500, this goes from 2000 to 2014. These were the returns of these various asset classes. So the S&P 500 returned about 4.24% during that time, with a lot of volatility. Because that would be tough to wake up and open your statement and see your S&P 500 index went down 37%. That's a tough one to take. And the S&P 500 returned only about 4.24%. U.S. Small cap returned 11.78%. Dimensional U.S. large cap index returned 7.82. Microcap returned 13.9% during those 14 years. Emerging markets were up 7.38%. And then the Treasury Index, 1-3 years Treasury Index, which is government bonds, was up 3.3%. And then global government bond index was up 4.93%. Now these are returns, actual returns. Now I have to add a caveat here, okay, in case FINRA or the SEC is listening, which is that past performance does not guarantee future results. We all know that. But if you look historically, and that's what we're going to do, is we're going to look at a little bit of history today, you'll see that owning equities over the long term, not a short term, over the long term, equities have better performance, can outperform inflation historically by 6 to 7%. The key is, are investors long term? We know the markets are long term. The problem is, are investors? So this is a chart that we use sometimes. I try not to use it too much because it looks very confusing. But what this chart is showing, and this is how your portfolio, so your portfolio is based upon the science of investing. So all you know that behind the Matson money and the portfolios that we create, there is in about 50 years of academic research. Nobel Prize winning economists such as Dr. Harry Markowitz, Eugene Fama, Kenneth French, Merton Miller, Roger Ibbotson. There's a whole long list of academics that have studied how equities perform, how stocks perform, and how is it best to create a portfolio. So the one thing we want is we want assets. We want to own things that don't move together in the same direction. We want things that have some opposite movement. So what you'll see right here is these red squares. So the S&P 500 is 100% correlated, obviously, to the S&P 500. But the S&P 500 is only 67% correlated to microcap companies. That's good. They don't move all in exactly the same direction. So this little key over here says red is bad, blue is better, orange is even better, gray is good, and green is the best. So what you want is you'll see in this diagram, there's a lot of green squares. It means that when one is going down, the other is not also going down. They're having some non-correlated movement. This is, to summarize this, all this is modern portfolio theory. and that was from Dr. Harry Markowitz. He won the Nobel Prize for it. It simply states this, is that when you own assets that are non-correlated, that don't move in the same direction, what it does is it reduces the volatility of the portfolio, and it increases the return. And we show that in the myths presentation that we do, which I know most of you have heard that presentation, showing you how when you add more assets to the portfolio, your risk goes down and your return goes up. It doesn't mean that it eliminates risk. It's still possible, even with a portfolio that's very broadly diversified, to see a down period, okay, which we've seen in the last year, over a year now, that we've seen a down period in the market. So it's not immune from it, but here's an important point to understand. When the S&P in 2008 went down almost 40%, how difficult is it to come back from a 40% loss? It's pretty tough, right? I don't know, Dave, what's the number? If you lose
60,
yeah.
6%,
Yeah. Yeah, if it goes down 40, you've got to earn 66 just to get back to even. Okay? That's a large drop. So what you want to do, so by having a diversified portfolio, it's going to lower that volatility. It's going to reduce that volatility. It doesn't eliminate it. Okay? There would be no way to totally have elimination of all risk. The only way to eliminate all risk is to have something, put it in the bank. Of course, then you have no return. Okay, so these are the annualized returns from 2000. It says 2000 to 2014. I think this is it. No, that's not right. It should say this actually should be from January of 2015 to August of 2015. So these numbers are not right. I don't know how that happened, Elliot. I was just looking at it this morning, and it must have changed numbers. So this is just going back 8 months of last year, because Morningstar still hasn't given us the new data for the end of the year. So we'll get that in the next month or so. So the S&P 500 in 2015 was up till August was down 4.29%. U.S. small cap value was down 9.19%. And then large was down 8.97%. This is dimensional U.S. microcap was down 5.97%. Emerging markets, wow, down 18%, negative 18% emerging markets. It's funny, I never got any calls during this time for people wanting to buy more emerging markets. But that would have been the time to buy it, actually, when it was down that much. And then U.S. Treasuries were up 1%, and International Global Bond Composite Index was also up 1%. So you can see what a difference it is owning different asset classes because of the divergence in return. You got a negative 18 or a plus 1. That's a pretty wide spread from one to the other. So how did the Matson portfolio, how did your portfolio do with us, okay, during this time? Okay, investors fare during this extended bear market. So what I'll show you, this is going back to 1999, okay, all the way through 2000, near the end of 2013. And what this shows you is the red line right here is the consumer price index, which is basically a measure of inflation. Okay, so the red line is inflation. The blue line is the income and growth portfolio. That would be the most conservative portfolio you could own. Okay, and that is 75% in short-term fixed income and 25% in stocks. Okay, so only 25% in the stock market. Then there's the S&P 500, which is the red line right here. Then the balanced growth, okay, the balanced growth would be 50% in stocks and 50% in fixed income. And long-term growth would be 75% stocks and 25% income. So my kids, so Haneo, Mohan, Elliot, you all have portfolios. What are your portfolio at? I don't think you're aggressive. I think you may are a little bit step down from that, maybe like a growth portfolio. So the kids, growth portfolio is great for the kids. Why? For millennials.
They have a long time to let it grow.
They have a long time to let it grow. They can see ups and downs in the market. They're not going to touch this money for 25, 30, 35 years, hopefully. Okay? So they got plenty of time, so they want to take advantage of that growth. And then there's an aggressive portfolio. An aggressive portfolio is 95% in stocks and 5% in fixed income. So how did this do? How did the Matson portfolios perform during this period of time? So obviously this is starting with $1 million, and we're not all starting with $1 million, but even if you started with 100,000, you can do the math. $1 million in the consumer price index would be worth 1.3 million. That's the S&P 500. S&P 500 would be worth 1.3 million. If you had the income and growth portfolio, it would be worth 1.5 million during that time. Then you would have the this is the S&P. The red line is still the consumer price index. The S&P, you can see the swings in the S&P 500 here. That's pretty big volatility. I mean, that would be hard to stomach, that kind of volatility. Then you got the balanced growth, which would have 1.9 million, long-term growth, which would have 2.3 million, and aggressive growth would have $2.6 million over that 14-year period from 2000 to 2014. So you can just see that owning equities over time pays off to investors. The problem is this, okay? The big dips, the drawdowns, because that's where investors can get frightened and make mistakes. Also, the other thing is, if you unless you are really have an ironclad stomach, being in that kind of an aggressive portfolio would be hard to take because of the huge swings. Same thing with the S&P 500. But you'll look here, look at the income and growth portfolio. It's pretty level. I mean, it's had a little bit of a dip, but not that much. And even the balanced growth portfolio, it had a dip, but nothing like the growth or the aggressive portfolio, which have much higher volatility. So here's the bottom line, is that being diversified is very beneficial, and it reduces risk and increases return. But investors are doing exactly what they know intellectually, we know cognitively not to do, which is to sell low and panic. I'll give you an example. This was back in 2008, the recession of 2008 to 2010. I remember actually the week that the market hit the bottom in 2009. It was March 6th, 2009, the market hit the absolute bottom. It was like 6,500. That week, I remember hearing reports on the news and reading in the newspaper, $21 billion left the market that week. $21 billion. From that week, over the next 3 to 4 months, the market recovered over 30% of its gains, over 30% of its losses, rather. People who left and went to cash never got those gains, never rebounded from that loss. And this is another interesting chart, because this is showing net redemptions and inflows into the market. So the beige line here is actually the market performance itself. So it's showing the markets was up, and then it came down, and then it went up again, stayed kind of the same for a while, and then came down. This was 2008, the big market correction. And then from there, look at where the market goes. Almost straight up. The thing you'll notice is that every time the market goes down, you see those blue lines? That's cash. The center line is zero. Below that line is money coming out of the market. Above that line is money going into the market. So what's the interesting thing you notice about that? When the market goes down, what happens to outflows? They increase. And then you'll see when market went back up, increases went up. But here is the real problem. We had 2008, huge outflows from the market, but look what happened here. People got scared and never went back in. So a lot of people who left the market in March of 2009 locked in their losses permanently. In other words, they got zero return. Because where have interest rates been at the banks? What are interest rates at? Interest rates are at zero. I think someone said, oh yeah, the bank was paying me 0.010%. It's pretty much zero. So what you see is that investor behavior is happening here, that people get frightened, they don't understand what they have. See, here's the amazing thing, is that we meet a lot of investors, a lot of people come to see us and show us their portfolios, and I'm amazed at how many times they have no idea how much volatility is in what they own. They don't know how much it could go down. So that's one of the 20 must-answer questions that we always ask, which is, do you know how much volatility is inside your portfolio? Benjamin Graham said this. He said that the investor's chief problem and his own worst enemy is likely to be himself. Everyone remember that movie Horse Whisperer? Did you ever see that with, what's his name? Robert Redford. Very good, Jerry. Robert Redford and Jane Fonda. And Robert Redford has this special talent dealing with horses. So Jane Fonda calls him and asks him to come over. And she says, I'm looking for someone who can help people who have horse problems. And Robert Redford's answer is, well, you don't want to hire me, because what I do is I help horses who have people problems. And it's kind of the same way at what we do as coaches. And please don't take offense to this, but we help portfolios that have people problems. Okay? We're working with people who have money, but there's problems. In other words, when it boils down to when things look bad, when there's a lot of blood on the street, so to speak, when the blood is running in the streets, there's bad news. There's constantly, we watch the 24/7 news cycle. We're constantly being told this is the end. Get out, go to cash, buy gold, dig a hole in the ground and put your family in there because it's going to be, the world's going to end next week. We get bombarded by this stuff all the time. We're all human beings. We all have emotions. We get affected by it. So what are investors being bombarded with? Such as hype. Okay, there's a lot of hype out there. Here's a book that was written, Commandments, the 7 Commandments of Stock Picking. And I won't read this here, but basically he says, don't get caught in the diversification trap. Find out what's going to be hot and then put all your money there. The only problem is, who has the crystal ball to know what's going to be hot? Nobody does. Or how about this guy? Be a real estate millionaire. He wrote this book, this Dean Graziosi wrote this right before the subprime mortgage meltdown. By the way, did anybody see that movie, The Big Short?
It was excellent.
Great movie. Great movie. I highly recommend you, if you have a chance, might want to write this down. It's still out in the theaters, starring Steve Carell, and Brad Pitt is in it. It's just an excellent movie. It's a true story of what happened in 2008 during the subprime mortgage meltdown. Excellent movie to see. I went and saw it twice, actually. I liked it so much. Or how about this guy, Jim Rogers, A Bull in China. Take all your money, investing profitably in the world's greatest market. Now, if you had put all your money in China, where would you be right now? You'd be in big trouble. Okay, so chasing hot sectors there's always someone out there that is going to be promoting something. Then there's the horror. These are some of the horror headlines. Again, the 24/7 news cycle, we're constantly being bombarded with this stuff. Consumer prices driven by fuel surge 1.1% in June. Democrats see a need for further economic stimulus. This was in 2008. Stocks soar in drop in oil prices, Wells Fargo report. Now it's funny, they're saying that stocks soar as oil prices drop. Okay? Then there was another headline at about the same time that said, oil prices going up, market's going to crash. So the market's going to crash if it goes up, and the market's going to crash if oil goes down. So either one. Then Fed chief bleak on economic outlook. Seeing bad loans, investors flee from bank shares. Opposition from both parties over bailout. And then there's the fearmongers. This guy, George Soros, is one of them. Okay, the new paradigm for financial markets. The credit crisis of 2008 and what it means. Okay, the thing that we have to be aware of as investors is that there are a lot of people out there that would like to sell us stuff, to sell us books, to sell us magazines, or to even sell us financial products that don't make us money, it makes them money. They're making money off the fear industry. There's actually a fear industry. Have you ever heard of that? And the fear industry right now is in full bloom. So this guy, Peter Schiff, actually he owned a broker-dealer, and one of the recommendations he made in his book is guess what to invest in? Anybody? What do you hear all the time on radio and television? Invest in what? Gold. He was insane. You got to invest in gold. Gold is the ticket you got. Well, he owns a broker-dealer, and guess what they sell? Oh, wow, what a coincidence. Okay. Then there's this one, How Wall Street Caused the Mortgage and Credit Crisis. This is kind of like The Big Short. The Chain of Blame. But the biggest offender is Howard Ruff. You might have heard of the Ruff Report. Okay, Howard Ruff's been around for 40 years. And Howard Ruff, this was in the 70s. This was How to Prosper During the Coming Bad Times. Then he wrote another book, and his recommendation in the book was Sell Stocks and Buy Gold. This was around the 1970s, late 70s. So we know that gold went up in the early 80s to about $800 an ounce, and then guess what happened? It crashed. It was down about $300 an ounce, and it was that way for what? How many years, Craig?
No, 10, 15 years.
Yeah, at least.
More than that, maybe.
Maybe even 20 years, yeah.
It was a long, long time.
It was. Gold was just flat.
Yeah.
This is Howard Ruff again. Survive and win in the inflationary 80s. Oh, Howard Ruff again. How to prosper during the coming bad times. And he's making a lot of books off of bad news, isn't he? I mean, if you were to read his book, it'd probably be pretty depressing. Oh, here. How to prosper during the hard times ahead. So he finally got rid of the bad times, and he calls it the hard times ahead. Safely prosperous or really rich. Choosing your personal financial haven. Howard Ruff. Bestseller. Oh, and here's this one. How to prosper during the coming bad years of the 21st century. Howard Ruff. Almost every one of his books is How to Prosper During the Bad Times. Bad years are coming for the unaware. But when you know what's really happening behind the scenes, you can make the best of your financial life. Thank you, Howard. Oh, here's another one. This is Harry Dent. You probably see him on radio, and he's on television quite a bit. He's a demographics kind of a specialist or prognosticator, I guess you could say it. The demographic cliff, how to survive and prosper during the Great Deflation. Now this is interesting. This is a chart showing you gold. Okay, so you can see gold is the green line right here, and you can see how volatile gold is right here. The blue line is the S&P 500, which is, it's not too bad. It's up and down a little bit, not nearly as volatile as gold. And then the red line is the U.S. microcap index, which is a little bit more volatile. But look at how gold actually performs against other assets. So this is the consumer price index. From 1974 to 2014, the consumer price index averaged about 4%. One-year treasuries averaged about 5%, 5.02. Gold, 6.08 during that same period of time. But of course, you have to calculate in taxes. So after taxes and inflation, gold is barely keeping ahead. Then you have the S&P 500, which averaged 11%. And then U.S. microcap index was 15.61. Again, past performance is no guarantee of future results. Okay, I'm not saying you're going to get 15% returns in your portfolio, but certain asset classes have way outperformed. So, one of the things about investing that I realize I repeat myself quite often because I think we all need some repetition sometimes. We need to hear this over again. And that is that anything good, I was once told, hey, listen, anything that's good, that is going to happen that's good, is going to take time. So it does take time. This investing is not a sprint. It's not a 50-yard dash or a 100-yard dash. It's a marathon, or maybe you could even call it a mega marathon. Meaning we need time. By taking advantage of time, investors can be successful. By being prudently invested, by being diversified. And also, it takes experience, too. Because sometimes investors that have never been through a down market, they get scared. And that's understandable. And even though the title of our little talk, which is Stop Worrying and Learn to Love the Bear, I'm not denying the fact that we all might feel a little hesitation and concern about what's happening. But there is a solution. The solution is having the long-term view. And the other thing is experience. If you've been through a down market before and then seen how the market responds, and when the market comes back, it comes back with lightning speed. And I'll tell you a personal experience of my own. In 1987, I was a young family man at that time. My wife, our daughter was 1 year old, and my wife was pregnant with our second child. And I went to see my accountant, or my guy who does my taxes, and I opened up my very first IRA account because I knew I better save for my future. So I opened up my very first IRA account, and I put $2,000 into it. Okay, do you know when I put that $2,000 in? It was 1987. Does 1987 October ring a bell? It was right before Black Monday. It was Black Monday.
That's right.
I put it in on Friday. I put $2,000 in the S&P 500. On Tuesday, I called to check on what the balance was in my account. $1,500. I lost 25% of my money in 2 days. I freaked out. Total panic. I called Vanguard and said, sell everything, and went to cash. I sold everything and I went to cash. This is a confession here, folks. I sold everything and went to cash because I knew nothing about investing. I had no investor coach to help me. I had just the guy on the end of the phone at Vanguard who didn't know me from Adam. So I went to cash. 6 months later, if I had kept my account, it would have been up to about $2,500. So I learned my lesson that I panicked. I panicked totally because I didn't understand how the markets work. I went to cash. So experience is very important. I only had to have that experience once, thank God. So to give yourself the best opportunity of being a successful investor, you must endure the down markets and use them to your advantage to buy low and focus on the long term. Now this is really important because this is how your portfolio is managed by us. Okay? It's not just a passive portfolio. What you own is what is called a structured portfolio. So what that means is you own not only stocks in your portfolio, but you also own what is called fixed income. And fixed income means short-term bonds, investment-grade bonds, meaning they're highest quality bonds. But everything is very short. It's under 5 years. So what happens is this, is when the market goes down, when stocks have gone down, okay, they're right now, if we were to use that analogy of the Macy's that I used earlier, stocks are what? They're on sale, right? They're on sale. So here's what we do, is we rebalance your portfolio. And we do this automatically. You don't have to call me up and say, Ray, I think the market's down, it's time to rebalance. We do this for you. What we do is we take some of the fixed income and we buy these stocks while they're lower. Buy low and sell high is the dream of every investor. This is done automatically for you in your portfolio. So what we're doing is we're doing this part here for you. We're buying low. The part that I need your help to do is just have that long-term view, to have the long-run view. We try to be the calm voice in the storm, so to speak. You know, it's another analogy I could give would be like flying in an airplane. I remember when I was 10 years old, it was the very first time I ever flew in an airplane. And I think my mom and dad, we were flying to San Francisco for something. And I was sitting at the window seat and right above the wing of the plane. And I looked out the plane, and we were now at whatever 30,000 feet, and I looked out the plane and I saw the wing, and the wing was going like this. And it freaked me out. I turned to my mom and dad and I said, Mom and Dad, the wing's going to break off. Look at it. It's going like this. Now you've all seen that, right? We all know that now. When engineers build something, they build it to have some variation to it. And the same thing can be said with your portfolio. And that's why we provide also tools for you. We've got Mainstream Money, also a couple other books that I could recommend would be The Investment Answer. You can get it on Amazon for like $7. Investment Answer. And the other book is Simple Wealth, Inevitable Wealth, which is another great book to read. Does everybody have this book, Main Street Money? No. Okay. Elliot, why don't you give everybody one of those? Everybody's going to get one of those today. Do you have one, Ben?
No.
Okay. I'm going to give one to you as well. And Jerry, do you have this?
No.
Okay. So we're going to give all three of those books out. Craig, I know you've got plenty, and Dave has plenty. And So even if you just read one chapter a week, and read this book, Mark Mattson put a lot of heart and soul into it. It's not real complicated or high technical. It's fairly easy to understand, and I'd recommend reading some of that. If not, you can get the other books, The Investment Answer or Simple Wealth, Inevitable Wealth.
Are we better off than we were 7 years ago, Mark?
Yeah, when I think about Lehman, I think about a cautionary tale for investors. And number one is don't get caught stock picking. Lehman was at $86 a share. 20 months later, it was at zero. That can happen to any company today. The other thing is that don't get leveraged up as an investor. They were highly leveraged. Investors margin their accounts. It creates a lot of risk. And finally, don't get caught speculating. Lehman was betting on the next 12 months that mortgages would keep going up and real estate would go through the roof, and they were wrong. Focus on the next 20 years and not the next 20 minutes. And I think banks are much better off than they were, than they were 7 years ago.
Keith, you.
Okay, so there's 3 simple rules to avoid disastrous results as investors. Number 1 is own equities and fixed income assets. So you own both. You own stocks and you own fixed income in the same portfolio. That's why we're able to rebalance it. If you had all stocks, we couldn't rebalance your portfolio because we have to call you up and say, oh, quick, send us some cash so we can buy the stocks when they're down. How happy would you be with that call? Not very happy. So what we do is it's automatically internal to the portfolio. So we simply take the fixed income and we buy the securities when they're lower. Diversify among different equity asset classes, which we're doing. And periodically rebalance your portfolio. Buy asset categories in the portfolio that are relatively low and sell the categories that are relatively high. And then overall remain disciplined over a lifetime. It's like that commercial, shampoo, rinse, and repeat, basically. And just keep this going. A lot of investors, when they see the market going down, they're afraid, well, what if I lose all my money? Is it possible? Let's talk about that. Is it possible to lose all your money in the market? Okay, and how could you do that? How has someone lost all their money? Any suggestions or any?
If there's a war.
Okay, if there's a war, you lose all your money. But specifically, though, how could you lose all your money? Because the stock market, even during World War I and World War II, never went to zero. Investing in what, Dave? One company. What Mark was just talking about here, Shearson Lehman. Do you know that guy on the cable television by the name of Jim Cramer? Mr. Boo-ha-ha? Okay. 3 months prior to Shearson Lehman and going out of business, he was saying you must own this stock. 3 months before. So it means if you buy individual stocks, yeah, there's a chance you could lose all your money. Why can't you lose all your money in the portfolios you have? Simple reason is you're diversified into 12,000 companies. For all those companies to go to zero, we would have to have an extinction level event, meaning we would have to have been hit by a comet or a meteorite that destroyed all the dinosaurs.
You need a shotgun and tin food.
It wouldn't make any difference if I had money.
That's exactly the point, Jerry. You wouldn't have an ATM machine to go to.
Yeah.
There wouldn't be one. So the thought that your money is going to go to zero it's an emotional thing. It's not a realistic thing. Even during World War II, and I could show you, we don't have in this presentation, but I could show you in slides where even during World War II, the market was going up. But there was bad things happening, and I admit it. There's always bad things happening. Yes?
How about communists take over?
Yeah, well, that's another danger.
That would impact your portfolio.
That would impact it.
We'd have to share our money out.
That only affects one country.
But that's okay. That's okay, Ben, because what they'll do is they'll share your money with me. I'm just kidding. So the reality is, no. If you have a broadly diversified portfolio, your money is not going to go to zero. Okay, it can go down. It's not going to zero. But I tell you this, the next up movement will be 100%. The next 100% movement is not down. Because if it moves down 100%, we're all at zero. And there is no more businesses, there is no more life. Our planet is toast. Okay? And that's not going to happen, at least not yet. Okay? But the next 100% will be an upward movement. And why can I say that with confidence? Again, past performance does not guarantee of future results, but let's go back to 2009. The world was coming to an end. It was March 6th, 2009. The world was coming to an end. $21 billion left the market. And what happened after that? The market has tripled in value since then. And people that went to the sidelines and hid under their bed and put all their money in the bank got zero. So it is a painful part of being an investor. But if we understand his history, if we understand how markets work and how they operate, we can survive it. So here's how the different portfolios you might own work. So my kids have this kind of a portfolio. It's a growth portfolio. Most of our clients are somewhere in here. A moderate would be a 50%, 50-50. So 50% stocks and 50% fixed income. Conservative portfolio would be like 75% fixed income and 25% stocks. This is how, now, the way the portfolios are designed is they are engineered to have some elasticity. So when an engineer builds a gigantic building, the building doesn't just stay there rock solid and doesn't have any movement. They have actually, even now in downtown Los Angeles, when they build, have you heard that before,
Yeah.
Kathy?
I had an office on the 50th floor, and luckily I hadn't arrived at work yet, and it rolled, and the people...
And there was an earthquake.
And the people that were there early panicked. It was very scary.
Very
But it
scary.
worked.
But the rollers worked, right?
Yeah.
Well, your portfolios are the same way. This is what we call the vortex, the investing vortex. And what you'll see is that in the initial years, there is a probability, there's a possibility of a downward year or a down year. So, but you'll see the longer the portfolio is held, this first 1 to 4 years is a period where there could be the most fluctuation in the portfolio. But there is a 95% confidence level that it wouldn't go below this the orange line or above the purple line. That is the conservative portfolio. That's 75% fixed income, 25% stocks, and over a 20-year period it's averaged 6.73%. What you'll see is as the years go out, the lines get closer and closer together, meaning it's sucking out the volatility of the portfolio the longer we hold it. Okay, so in any 1 year period there's a possibility of a -5 up to a +18. There's 95% confidence level in this, that it's going to be somewhere between here. If we hold the portfolio for 5 years, it's a -0.7 or +13. 10 years is 0.79 to 12. 15 years is 1.7 to 11. And 20 years is 2.7 to 10.6. That's the conservative portfolio. The moderate portfolio, which is 50% fixed and 50% stocks, has a historical return of 8.48%. But you'll see that the possibility, the confidence level now spreads out a little bit. There's a little bit more probability that there could be some negative years, okay? And that can fluctuate anywhere from a -11 to a +28. Or if you hold it for 10 years, 0.99 to 15, and 20 years, 3.5 to 13%. Next is the growth portfolio. This is 75% stocks and 25% fixed income. So this is the reverse of the conservative portfolio. Historical return 9.96. You'll see now the wings can flop a lot more, okay? But they're not going to break off, okay? The return is going to be somewhere in here for the first 4 years. But again, you'll see that the volatility starts. The longer the portfolio is held, the more the volatility is being sucked out of the portfolio. So it can go anywhere from a -19 to a +39% returns in any 1 year. Over a 10-year period, it's 0.64 to 19, and over 20 years, it's 3.7 to 16%. And it looks like this. Now, this is the aggressive portfolio, historical 10.8% return, big variance for the first 4 years, and then it starts, the volatility starts coming out. And that can go, that's a pretty aggressive portfolio. It can go from a -27 to a +49%. Over 10 years, -0.24 to a +22, and then 20 years, 3.5 to 18. And these are the charts, these are the lines all together. So this is the conservative, the moderate, growth, and aggressive. You'll see as they go out further, the longer the portfolio is held, the less the volatility, and the greater probability of achieving that return on the line. The problem that investors have, that's called the portfolio vortex, which means that the longer the portfolio is held and then it's disciplined and rebalanced, then we're going to get, the higher the probability of getting true market returns. Here's the history experience of most investors. Everyone's heard of Dalbar? Dalbar is an independent company that just does research on investor behavior. And they analyze how investors have performed versus how the market itself performs over the long periods of time. So what they found is that the average investor, Dalbar, after studying hundreds of thousands of investors, they found that the average investor over the past 30 years earns about 3.7% in the market. And you might say, well, how can that be? The market's got 10% or 11%. How come the average investor can only be 3.7? And the reason for that, the Dalbar is right here. This is the average investor. The reason is that investors start their investment portfolio, they make it 3 or 4 years, and guess what happens then? They change it. They sell it. They move to something else. They chase gold. They chase international. They chase emerging markets. They put it in cash. Then they get back in and start over. And then they go another 3 to 4 years. And then what happens? The market has a correction. Investors get scared. They jump out. They chase something else. They change the portfolio. They start over again. So investors keep starting over. So portfolio A, B, C, D, E, F is investors continually starting over again. Jumping out, jumping back in, chasing other hot sectors. It is a simple formula for destroying returns. So the Dalbar study basically has shown that. So the best defense is what Jack Dempsey would always say is a good offense. Meaning, understand the strategy. And it's kind of like this. If you were in an airplane and we're traveling from New York to California, and most of the time, how many here have been, I know, Ben, you've done a lot of traveling. How many here have been in really serious turbulence flying? Anybody? Very few times. But has anyone been in turbulence? It's kind of scary, right? So if I was flying in a plane and there was turbulence, like the stock market, it's turbulence. When there's turbulence in the plane, does the passengers jump out of the plane?
They can't get out. They could, yeah.
They could, right? Yeah. Okay, well, what would even be worse is, let's say there's a lot of turbulence, someone gets scared, and I'm sitting in the middle seat, and I've got someone next to me, and they're frightened out of their mind. And they go, and they turn to me and say, "I'm jumping out."
Not over me.
And then if I was a good friend and a good coach, I would hold their hand. If I was a lousy coach and a lousy friend, I'd say, "Okay, good luck. Hope you enjoy the landing."
Yeah.
Okay, so that's really our job, and that's why we hold these classes. We're doing another one tomorrow in Long Beach. We've got about 10 clients coming to that. But the whole point is that what we really want to do is see that this is a marathon. It's not a sprint, and the market's not going to go to zero. You're not going to lose all your money tomorrow. Even if the market does go down, and this market downturn at some point, I don't know when, at some point it will be over. And when it's over, guess what's going to happen? The market's going to come back, and it comes back with lightning speed. And all you have to do is look at history to see that. And my personal experience in 1987, selling everything and losing 25% in one day. But I'll never do that again. So, any questions? Do we have any questions? How are we doing on time? We're right at an hour. Is there any questions from anybody who's watching over the internet? Are they able to respond? Elliot, I don't know if we've gotten the technology yet to be able to take questions. Can we? Is there anybody out there who has a question? Kathy? Jerry?
When you rebalance these like that, does that show up on our monthly? It does. On our monthly, when you get it.
Okay, that's a good question. So the question Jerry asked, and I'll repeat it for the people listening on the microphone. When we rebalance the portfolio, does it show up on your statement? And the answer to that is yes. Okay, so quarterly you'll see a lot of activity on your statement. You might wonder, well, what's this activity going on? What's Ray Martin doing with our money? And what's happening is we're rebalancing the portfolio. So we're selling some of the fixed income, and we're buying these stocks while they're lower. So it will show up on your statement. And when it happens, actually, if you're looking at your portfolio online, it'll look like your portfolio suddenly went down like 1 or 2%. And the market could have been up, but you went down. The reason for that is that the transactions still are clearing. And once they clear, you'll see your portfolio immediately go back up. And that's because there's selling of the fixed income and buying the stocks while they're lower. The other thing I wanted to mention, and I'm glad you brought that up, Jerry, because the turnover on these portfolios is very low. It's about 11%. What that means is the buying and selling stocks is very, very low in these portfolios. Most mutual funds, I don't know, Craig, what do you think the average turnover is?
80%.
About 80 to 100%. I've seen some turnovers of like 200%. It means the manager is buying and selling stocks continually throughout the year. So what does that do to a portfolio when you see that much active trading going on? There's a cost to it. Guess who bears the cost? It's the investor. So you have very low turnover in your portfolio, and there is so because of that, but it's not totally passive. That's my point, is that we are watching it, and when the market does, when a particular asset class goes down more than 5%, we're going to take some of the fixed income and buy more of that particular stock. Yes, Ben.
But it's a fixed date, right? Not like you feel, oh, today is low, I'll do it today. So only 4 times a year to do that?
Regularly, it's 4 times a year, but if there is a severe downturn, yes, it will be rebalanced.
Yeah.
So it's actually not a time, it's a percentage. It's a 5%. So if an asset category goes down more than 5%, we're going to rebalance that. Yeah. But the regular intervals should be quarterly. So they're looked at quarterly to rebalance, but they could be done sooner. Could be done more frequently.
That also means that if one section is pretty good, you might lose some money, right? Because you don't rebalance it.
Repeat that again.
I mean, if like a stock's shooting up,
Yeah.
then you say, that, oh yeah, you don't want to do that. I mean, you rebalance it before. Say, example, you're gonna go up to 30%.
Yeah.
But then at 5%, you start to rebalance it, right? So
Yes, but what that means is if a stock is going up, if a particular asset class is going up, okay, that means we've already bought it low. Okay, so that means when it's going up, we're going to sell some of it. We're not going to buy more. We're going to sell some of it and take the profits off the table, which is what we want to do. We want to take the profits off the table and put those into fixed income or move them into some of the, it could be done with moving them into some of the other asset classes.
so
Yeah.
not that greedy.
That's key.
Well, safety first.
Safety.
There's two.
You got to keep your portfolio. If you have a 50-50 portfolio, you may, after one quarter, you may be 55% in equities and 45% in bonds. So they're going to take that 5% and reallocate it to spread it out there amongst the asset classes that have gone down.
Right. Yep. Okay. Please help yourself. We have refreshments. We're going to stick around for a while. We can talk. That's going to be basically the conclusion of our class today. And thanks. Thank you. And we appreciate having the online audience out there. We appreciate very much everyone participating today. And if you have any questions, feel free to call the office, and you can talk to Craig, Dave, or myself. Okay, thank you.